All right, let's just dive right into this explainer. Today, we're putting our sell-side equity analyst hats on to investigate a genuinely massive disconnect in the market. We're putting Power Integrations, ticker symbol POWI, under the microscope to build a rigorous, fully documented stock valuation based solely on their financial filings. Our goal here? To figure out exactly what the market is pricing into this stock and whether the underlying fundamental math actually supports it.
Right out of the gate, boom, we're hit with this staggering figure. Negative 150.75%. This number right here represents the negative margin of safety for Power Integrations. Currently, the stock is trading around $73.28. But the data tells a vastly different story, listing a fundamentally calculated fair value of just $29.22. In the world of equity analysis, a negative margin of safety this steep means the stock is trading at an extreme premium to its intrinsic worth.
So, what does this all mean? Why on earth is the market paying such a massive premium for POWI? To solve this mystery, we're going to use our absolute, relative, and asset-based valuation models as forensic tools. We're going to unpack the discounted cash flows, stress test their dividend policy, and compare their market multiples, extracting every drop of insight to see if this premium is justified or if it's just an illusion. Here's our roadmap for today. We'll start with the valuation mystery, move through our absolute valuation models, check the dividends framework, look at relative valuation and peers, and wrap up with our final intrinsic verdict. Let's get to it. Starting off with Section 1, the POWI valuation mystery. Let's lay down some ground rules. As professional analysts, we're relying strictly on the hard data provided in the filings. But, modeling the future always requires a few missing puzzle pieces. So we'll explicitly flag when we need a specific data point, like a weighted average cost of capital or specific peer companies. When we hit those gaps, we're declaring the analyst's prerogative and applying sensible, industry-standard defaults to keep our models rock solid and realistic. Moving to Section 2, absolute valuation models, starting with the classic discounted cash flow. Okay, looking at the data, both of these absolute intrinsic values fall dramatically short of the current $73 stock price. It's a severe fundamental disconnect. A DCF based on free cash flow gives us a fair value of just $29.22. And honestly, it gets worse. An earnings per share based valuation pegs the fair value at an abysmal $16.24. That literally implies a negative 351% margin of safety. No way around it, that is rough. Now, by declaring our external assumptions for a standard tech industry WACC, around 8 to 10%, and a terminal growth rate of 2 to 3%, the underlying math becomes painfully clear. While the 5-year free cash flow growth is hanging in there at a positive 9.63%, the trailing 12 months of net income has absolutely collapsed by nearly 31%. When you plug a 30% drop into a DCF model, well, it completely crushes the present value of those future cash flows. You literally cannot mathematically justify a $73 price tag when the profit engine is sputtering out that fast. All right, Section 3, dividends framework. Let's look at the dividend discount model. Let's see if income investors are the ones irrationally driving up this price. Because to be fair, POI does have a 12-year streak of dividend increases. But look at this payout ratio trajectory. It's terrifying. Historically, their 5-year average was high, sure, around 80%, but their current metric, 211.25%. That means the company is currently paying out more than double what it actually earns in net income just to keep that 12-year streak alive. Crazy, right? If we build a multi-stage dividend discount model, it immediately flags this dynamic as a fatal error. Look at the mismatch. You've got a 5-year dividend growth rate compounding at over 10%, while 5-year net income is shrinking by nearly 21% a year. Near-term dividend growth is fundamentally unsustainable when your earnings are shrinking. Eventually, the cash runs out, the dividend gets cut, and any DDM valuation you built just instantly crumbles. On to Section 4, relative valuation and peers. Let's see if this premium is just standard for the industry. Since our source documents don't list specific competitors, we're using our analyst prerogative. Again, we're benchmarking against General, Analog, and Power Semiconductor publicly traded peers, just to understand the baseline environment POWI is actually operating in. Now, these aren't just numbers on a screen. They are blaring alarm bells. The current price-to-earnings ratio is an astronomical 187.9 times. And an enterprise value to EBITDA of over 100? That literally means you're paying $100 for every single dollar of operational cash profit. Valuations like that demand absolutely flawless future execution. Yet we're seeing this massive multiple expansion, like the PE being 120% higher than its 5-year average, right alongside a 20% drop in net income. The market is paying top dollar for a business that's demonstrably slowing down. Finally, Section 5, the final intrinsic verdict. Let's look at the asset-based view. So if the cash flows are bad and the multiples are detached from reality, what exactly is holding this stock up? Well, here's the silver lining, and it's probably the anchor for retail investors: the balance sheet. From a strict net asset value perspective, POWI has a bulletproof foundation. Their debt-to-equity ratio is 0, literally no leverage. Plus, their current ratio is a massive 6.51, meaning they have 6.5 times the assets needed to pay off short-term liabilities. Now, because they have 0 debt, applying an adjusted present value model isn't even necessary here. There are simply no tax shields from debt to account for. But this pristine health likely provides a false sense of security, completely masking the underlying decay in their actual earnings. To summarize this explainer and deliver our professional verdict, yes, the company's financial foundation is totally debt-free and flush with liquidity. But the price you're paying for those assets is mathematically exorbitant. And while a sum-of-the-parts analysis is kind of moot without specific segment data, the holistic view is crystal clear. You're paying 187x multiple for a company whose net income is shrinking by 30%, all while they pay out 211% of their earnings just to float an unsustainable dividend. It really is the ultimate showdown between market sentiment and fundamental valuation. Sure, the balance sheet buys them some time, but the operational math points firmly to gravity. Which leaves us with the million-dollar question: when will reality finally catch up to the stock price? Will the market realize the emperor has no clothes, or is POI going to pull off some miraculous operational turnaround to actually justify this premium? Keep those models updated, folks, because a disconnect this massive rarely lasts forever.